All right, joining me is Miguel Kudry, CEO of L1, which has built a fully on-chain wealth and asset management platform. So I would say this allows financial advisors and asset managers to manage crypto assets on behalf of their clients. And this is done in a completely non-custodial way, which we'll explain what that means. But Miguel, it is a pleasure to connect. I think we've crossed paths out on X or Twitter before, but I think first time connecting in person. So welcome to the podcast.
Thanks, Nate. Great to be here, and yeah, finally good to be chatting one on one.
All right, so I thought a good place to start is to just jump right in with your platform, and then I definitely want to explore some of your hot takes on a variety of other topics around crypto. We can do that later, but first,
Sure.
just explain what L1 is. What is the problem that you're attempting to solve here?
So we describe L1 as an operating system for on-chain wealth and asset management. We call it an operating system because we're building on top of existing protocols and infrastructure. We bring it all together into a very simple, easy to use interface. And by combining the functionality of multiple protocols, we create something very unique. So when you think about financial advisors, family offices, asset managers, and ultimately their clients, they haven't really had a way to come on chain and actually access these financial products and services on chain from a single trusted safe place. And while the space has catered to crypto natives, a lot of these institutional investors and institutions and more traditional financial professionals have been kind of on the sidelines waiting for a little bit more usability. And so that's what we're solving. The biggest problem we're solving today in the short term is enabling financial advisors and allocators in general to work with investors who are already in crypto, the so-called crypto native individuals and institutions, because these investors have been diving into crypto for years. And any financial advisor that has clients, usually when you look at statistics on the younger side, let's say millennials and younger investors, there's a chance the majority of their clients are going to be exposed to crypto. And so our platform enables them to incorporate those assets into their practice, effectively enable them to give advice on those assets without their clients having to give up custody of their portfolio. And then long term, we believe that all asset classes are going to be tokenized. And as that happens, a whole industry that manages more than half of all wealth in this country is going to need a tool like L1 to continue to do their job.
Okay, so a lot I want to unpack there, but you mentioned the term custody. And if I were to boil down what you just described and how your platform operates, essentially what you're doing is you're allowing advisors to have read only access to their clients' digital assets and then make recommendations in a non custodial way. And so, explain that. What does non custodial mean? I just want to make sure everybody's following the basics here.
Yeah, so I think a good way to describe it is to start off with what traditionally has been done. So traditionally, if you're an RIA, you work with a custodian or more than one custodian, and you're sort of onboarding your client, and they are signing over their assets to your discretion and effectively your custodian's control. So whenever those assets hit your custodian, you're sort of operating within their walled garden. So your clients can only access products and services that are made available by that custodian. One of the biggest innovations in crypto is the fact that you and I can take our assets, our net worth, and really take it anywhere in self-custody. So for the very first time, you separate control from somebody's ability to add value and interact with an asset like ETH, like Bitcoin. And so that actually enables a lot of different use cases that we are building L1 around, which is I can bring my wallet and work with not just one advisor, but multiple advisors. I can kind of plug in and out and get to work with you in minutes, as opposed to what traditionally takes weeks for a client to actually onboard with an RIA, sign over custody to the RIA's custodian, and kind of get to work. This eliminates a lot of that friction. pretty much all of that friction. And so you can effectively put your assets to work and have people interact with those assets, but you as the investor remain in control at all times. So it really changes the game for anybody that's in the business of wealth management, asset management, and investors as well.
For wealth managers, talk about how they go about making recommendations. And perhaps this gets us down the path towards talking about the on-chain separately managed accounts, the SMA. So my understanding is these are both discretionary and non-discretionary SMAs. So perhaps you can explain both of those, what that means.
Absolutely. We started L1 in 2022, and originally our product was built around a non-discretionary approach. It was, at the time, it was a brutal environment from a regulatory perspective. We wanted to really go to market as quickly as we could to validate the whole business model and the thesis. And so a non-custodial approach was the best way forward. And so our first product enabled a financial advisor to make transaction recommendations to somebody that is in self-custody. And then that investor, that client, would come to L1 and then sign each individual recommendation. So a recommendation could be something like a swap. Maybe the advisor recommended a tax loss harvesting strategy, or diversifying a position. Maybe they are overexposed to certain assets. A swap could do it, or lending. Maybe the client needed some liquidity, and so the advisor would say, okay, well, here's a recommendation for you to collateralize some ETH and then borrow USDC against it. We cover a lot of different protocols on the platform, and so that actually enabled us to get feedback and interact with a number of different clients, from very crypto native individuals all the way to normie investors, as we call them, people who are just getting their their toes in the water. And we learned that a vast majority of the market was really craving a discretionary solution, which is what they're used to in the traditional markets. And so we ended up building what we now call the Onchain SMAs as a way to give advisors that discretionary ability without actually giving the advisors custody or full control of the assets. And so this is possible because of that very nature of non-custodial wallets and the ability to separate discretion from custody. So on-chain SMAs is our response to the market's demands for a discretionary solution where a client brings their wallet, you still have your own wallet, and then you contribute to an SMA that might be running different strategies, like there's a lot of different things that we're about to announce, but it ranges from things like yield on stable coins to ETH staking and other more complex actively managed solutions and strategies. But effectively, a client brings their wallet, they make a contribution to an SMA, and then they sign over discretionary rights to the advisor or the asset manager to conduct specific transactions. So as a manager, I'm now able to do things that are within my discretionary rights that my client has signed over. The client already signed. The client has contributed the assets, and they don't need to come back. Unlike our very first product, they don't need to come back and continue signing. I can now manage that portfolio. And if I try to do anything that hasn't been approved by my client, transactions fail automatically. And of course, advisors and asset managers cannot withdraw customer funds. So that's how we keep these SMAs fully non-custodial and not subject to the custody rule, which was a must-have to really go to market.
In terms of some of the strategies that are available, I was poking around on your website. I saw there was like a CoinDesk Select index. There was a market vector meme coin index. Are those strategies that can be deployed within client accounts?
So those are basically strategies that are about to be launched. So one of those, so the CoinDesk, we have a couple of CoinDesk indices currently live on the platform. They actually went live with our first product. So you could actually subscribe to one of these indexes. And the difference is you would have to come to L1 and sign transactions every time the index rebalanced. And so that was actually good for some people that wanted full control. But for a vast majority of investors who would be the types of investors to actually invest in an index, it was a non-starter. So we are taking these indexes and turning them into self-rebalancing kind of model portfolios, and we're going to be launching them as strategies within these SMAs. Another set of SMA strategies that we're launching include ETH staking and the ability to generate yield from your existing ETH holdings. And because of the programmatic nature of these SMA strategies, you can actually get into very complex tools like looping, for example. You can take your ETH, your principal, and collateralize it on a protocol like Aave, and then you borrow something like wrapped staked ETH. And as long as you're paying your interest on that loan is lower than what you can get in yield from the liquid staking token, you can loop multiple times and basically get 2, 3, 4, 5 times more yield than you would be able to get on your own. And this is with a very risk managed approach. We work with Gauntlet, which is a DeFi risk manager. And so we're able to do these things because you are essentially programming these strategies on smart contracts that get deployed on chain. And so we're going to be able to support things like stablecoin yield, which will do things like arbitraging between tokenized treasuries and DeFi yields on USDC. So now that the Fed is lowering interest rates, I think we're going to see DeFi yield on stable coins going up. And so you don't have to worry about that. You just subscribe to this strategy and it'll automatically get you the best yield. It's starting to actually create a really interesting narrative that a lot of traditional investors, I think, have shown a lot of interest in.
You were alluding to this a little bit at the top, but I'd be curious how you would compare on-chain SMAs to traditional crypto SMAs that are currently available. How would you boil that down?
So on-chain SMAs are everything that people love about traditional SMAs, with the functionalities of that only crypto rails enable, which actually makes them 10 times better. So I think the first thing is really 24/7 liquidity. The fact that it can be a Sunday afternoon or Sunday evening, and you can actually go and rebalance an on-chain SMA with any sort of asset. These on-chain SMAs take any tokenized asset, whether it be a crypto-native token like ETH or a tokenized security or alternative investment. These SMAs take any asset. The other very interesting and appealing aspect is the yield possibilities. You can now take any asset, wrap it in an on-chain SMA, and generate yield on it, whether it is from liquidity providing on any of the supported decentralized exchanges that we support, lending. You can actually take some collateral and lend it on Aave and other protocols. You can do a lot of stuff with these assets on chain 24/7. Nobody can really stop you or control basically how you put those assets to work. And so it gives the investors and the asset managers a lot of flexibility to say, well, we're going to put 10% of the holdings in this SMA, and we're going to generate yield. I think that's very, very appealing from what we've heard so far. The fact that these can be programmatically rebalanced, it saves a lot of time from basically having to go into each account and manually rebalance and having to worry about kind of liquidity and best execution. This basically just takes care of that. So there's a lot to like, and it can only be done with crypto rails, which I think is going to open a lot of people's eyes about the benefits of crypto beyond whether you believe that crypto native tokens are a good investment. It's all about the power of these investment wrappers. And we're going to, I think SMAs are just a starting point. I think we're going to see that with ETFs and other types of structures.
Okay, so you gave me a perfect segue here. You mentioned ETFs, which we can talk about the tokenization of ETFs later, but you also mentioned only being able to do certain things on crypto rails. And as I believe you're aware, I'm a TradFi person, right? I come from the ETF space. I've covered it for a long time. And by the way, you don't have to cater your answer towards me because of that. But I'm curious. Let's just assume that um, you know nearly every crypto asset or every major crypto asset is available in an ETF wrapper. Okay, let's just assume that that's the case at some point. How would you compare spot crypto ETFs to on-chain SMAs?
Great question. I think spot crypto ETFs are a great solution for an investor that wants pure exposure to crypto as an asset class. We're never going to compete for a position in that type of investor's portfolio. Um, I think it's a bit of a generational divide between, let's call like boomer investors who are typically looking at crypto as like a 1%, 2% allocation. Most are still at zero, believe it or not. Um, we're not going to be the platform for those investors to really manage their portfolio. I think spot ETFs are great, low fees, very efficient, uh, and like I mean, there's really not a lot more that you can ask for if you want pure exposure. On-chain SMAs are really catered towards the next generation of investors. I think anybody that's been dabbling in crypto for the past several years, let's call it, has become very comfortable with self custody. Most likely, if you've been in crypto for some time, you've been doing a lot of stuff in DeFi. You've really kind of dove in, and so you are now fundamentally comfortable with being self custodied. You're comfortable with transacting on various different protocols. You are comfortable with the transparency and actually expect your assets to be like fully available 24/7, whether it is weekday or Sunday evening. And so if you're that person, you're probably a lot more exposed, quote unquote, than just 1 or 2% of your portfolio. I talk to people like myself, other crypto native individuals who, even through the bear markets, hold the vast majority of their cash on chain. I hold my cash on chain in the form of stablecoins because I can get access to yield. I can get access to lending and other products that I just don't have access to traditionally. And so for the next gen investor, on-chain SMAs represent a very appealing solution because they can now do things like tax-less harvesting strategies. They can do diversification in a tax-efficient manner. They can work with financial professionals who actually cater to their needs because they are already on chain. And so while I may hold some spot crypto ETFs in my retirement accounts, I will continue to hold the vast majority of my assets on chain. And I expect to do that especially more now that a bunch of other asset classes are being tokenized. So it's really about a generational shift and how the next generation of investors are going to look for the next generation of advisors and asset managers to work with, and that's kind of the market that we're going after.
How are you approaching the education piece? And I think everything that we've talked about so far here today, you've done an excellent job explaining. And I'll approach this from an advisor perspective. When you think about the spot ETFs, I think it's clearly made it easy for advisors who maybe don't have as deep of a knowledge of crypto to be able to get an allocation for their clients. They can explain it at a high level. But as you start to get further down the rabbit hole into some of the areas that you talked about, I do think there's a big education gap there. And that'll evolve over time, because if you're an advisor in the space and you have the next gen investor that you described who has an interest in being deeper into crypto, the advisor is going to have to raise their level of awareness around the ecosystem overall. That's going to be table stakes. But I'm just curious, as we sit here today, which I think we both would agree is still pretty early stage, how are you working to try to help bridge that education gap?
We've thought a lot about this and have kind of refined our take on this, on education specifically. I now really believe that to actually gain mass adoption, the focus should not be, especially for a company like L1. We're a very small company, very small team. We are probably not going to get there by educating the market. We're going to get there by building products that just are so intuitive that a financial advisor can come in and actually get to work in a very simple way, as simple as they want it to be. And then as they gain more experience and they get more comfortable with the tools, they can do more and more complex and sophisticated things. So that's kind of our primary focus. I think the vast majority of RIAs, so over 15,000 RIAs in the US, probably less than 0.5% are actually ready today to use a tool like L1. We do believe that the app layer, which is where we're focused on, is going to get so much easier over the next 5 years, let's call it. I used to say 10 years, but I think things are actually getting exponentially better. That you're just going to increase the addressable market of a product like L1 and other crypto native products, so that more and more of these RIAs are actually able to onboard without you having to educate them. I think that's the ultimate end state. I think there's also something that's going to happen, which is, I call this the shopification of wealth, where we're going to go from, my thesis is we're going to go from 15,000 RIAs in the US to 1 million RIAs in the US. Running an RIA, a registered investment advisor, today is extremely expensive. It's I mean, especially if you reach 100 million in assets that you have to register federally with the SEC, you have to find custodians, you have to have compliance operation, like a compliance operation. You need a whole apparatus that just makes it very challenging for a small shop to serve clients at scale, and not even at scale, rather like to actually get started. And so that creates a lot of basically, it makes the larger RIAs, the so-called platforms, much bigger, because they go and acquire smaller shops and basically roll them in, and they benefit from the economies of scale that their infrastructure provides. Much like running an online store was like a decade ago. Like if you wanted to run an online store as a single operator, it was very hard, like to figure out logistics of shipping and getting a proper website where people could go and buy your inventory. It was very hard. Only the larger consumer brands were able to build good online store experiences. And then Shopify came along and made it easy for anybody to go and launch a world-class e-commerce store. I think the same is going to happen with the RIA space. I talk to individual advisors at larger firms who tell me that they, for a long time, things are changing now, but for a long time they were forbidden from talking about crypto. And they knew clients were in crypto and they could not talk about it. They could not address that. Those individual advisors are going to be the first ones to go and leave and start their own firm when they can actually basically put together their own operation on chain and serve those very clients that they were not allowed to talk about crypto with, because those clients hold 20, 30%, some more than that, of their net worth on chain. And so crypto rails actually enable a whole new generation of financial advisors to come to market. And like an online store, you're going to be able to deploy an RIA and actually focus not on maintaining infrastructure, but actually serving your clients and giving them advice and understanding who they are as an investor. And it's just going to explode the number of financial advisors out there. That's my.
I love the way you describe that, and really, the end result of that is the advisor accrues the benefits provided by crypto and the underlying blockchain, and that you're accruing the benefits of things like transparency and access, right? 24/7 availability. And using your Shopify example, it's not like everybody can explain exactly how the back end of those websites are working and how the technology is working, right? But they receive all the benefits of it. And I think on a longer term time frame, that's what you're hitting on, is that advisors will be able to take advantage of those benefits that the
Absolutely.
crypto ecosystem is providing. Going back to your L1 platform itself, and obviously you're not here to dispense legal or compliance advice to financial advisors. I want to be very clear about that. But can you talk at all about the regulatory environment surrounding this? So my sense is, Miguel, that a number of advisors are hesitant to even explore a platform like yours because they just don't want to be in the business of offering advice on digital assets in any way, shape, or form. And so I'm just curious, how would you respond to that? Again, not offering any formal guidance here, but I'm sure this is a question you've received before from advisors just around the compliance or legal component.
Totally. I mean, sentiment is shifting very quickly, but it's been an uphill battle, especially since we started. We wanted to launch the product in a fully non-custodial way to eliminate a lot of those risks. Certainly don't want financial advisors to be in control of their clients' digital assets. And in reality, investors who hold digital assets on their own are never going to hand over those keys to their advisor. I mean, that's the bottom line. When you think of regulations, the SEC has been, their approach of regulation by enforcement over the past several years in this space has made our job incredibly difficult because the SEC is the ultimate regulator of these advisors. So it's kept 99+% of financial advisors on the sidelines. Even though we've gotten legal opinions on the impact of self-custody and non-custodial, non-discretionary approach to crypto advising, not being subject to the custody rule, the conversation was always, I mean, you could actually convince somebody that their clients needed some guidance when it came to crypto and self-custodied assets, but the compliance piece was always the ultimate hurdle. I think this change that's actually a turning point in a new SEC that's going to, I'm not even going to say be helpful, but just stop their approach of regulation by enforcement and not providing any sort of guidance, is actually finally permitting these advisors from actually being open to trying things. And we've had to sort of be laser focused on the subset of advisors whose business actually relies on like going after crypto native individuals who need the most help, because the vast majority of the market has turned them away. For those advisors, our product is a must have. They can't run their business without it. Now with less negativity on the regulation side of things, we can actually start conversations with a wider base of advisors that are going to be actually not just curious, but looking for products that enable them to talk about crypto and incorporate their clients held away crypto assets. From our perspective, we continue to build products that are compliant, no matter what the current administration's take on this whole topic is. What changes is how much addressable market we can go after in the short term. I think if I had to think about a regulatory strategy as an RIA, a non-custodial approach to crypto advising is a lot more efficient, because you don't have to go and find a qualified custodian. You don't have to have the legal framework and the kind of the operations as a firm to support a custodial approach to crypto advising. If you rely on your clients' self-custody assets, which they're going to self-custody whether you help them or not, you remove a big part of just like it's not only an expense, but also a risk, right? Like anything you do just adds risk. And so if you can remove the custody risk, no matter the current administration's views on crypto, I think it's beneficial.
So if an advisor is interested in getting started with L1, what's the basic process? What would be the initial steps?
So the best way to get started is to basically go to l1.co. sign up as a financial advisor, and immediately you can actually start inviting your clients. If you've had conversations with clients and crypto has come up and they've told you, yes, I own some crypto, or I own some meme coins. I've heard so many times from clients that just were playing with like meme coins, and they generated a lot of new wealth, and now they need to bring that back to kind of the advisory relationship to keep that wealth. um, they basically invite those clients. They can do that with an email invite, or they get a unique link that they send to their clients, and then the clients come in, they connect their wallets, grants them read-only access, and they can get to work. It literally just takes minutes.
Yeah, and it takes minutes because we're dealing with crypto
That's right.
versus the traditional finance space where it may take months to make that happen. Just out of curiosity, with your business approach, are you more targeting financial advisors, and then the hope is that those advisors will obviously onboard their clients and investors who are interested in crypto? Or is it the other way to where you'll have demand coming from investors that will attract advisors to the platform?
We're actually doing both.
Okay.
The initial approach, and I think our approach has kind of varied based on the kind of market sentiment and feedback from advisors. Vast majority of end clients do come from advisors who come to L1 and kind of incorporate L1 as their practice on digital assets. However, we've increasingly, especially in a bull market, we've had a lot of inbound from investors who don't have financial advisors, or who have financial advisors on the traditional side of things, and their advisor just doesn't get crypto, or in worst cases, they don't believe in it, and they are now looking to work with a crypto native advisor that can help them with their crypto and their digital assets. We've also started getting inbound interest from hedge funds, which I think is a benefit of going to market with an on-chain SMA product. A lot of hedge funds want to work with, let's call it, custody conscious LPs. Hedge funds run today on a kind of traditional fund model, where they commingle all funds, and then they manage them as a whole. They've been like coming to us to basically launch their strategies in an on-chain SMA wrapper, and that's actually going to also target RIAs. RIAs are constantly, vast majority of RIAs allocate to hedge funds in some shape or form. So I think that's also going to feed into the RIA distribution, and then ultimately the end investor, who now is able to access hedge fund grade strategies at a tiny fraction of the costs.
And just high level, we don't need to get into the weeds here. What's your basic revenue model? So how do you make money? And then for advisors, I'm assuming they can just easily bill on the assets that they're advising on, correct?
Correct. Yeah, that's one of the value props. An advisor can now charge a fee for providing advice on held away digital assets. They can choose their own fee, and we kind of power behind the scenes the snapshotting of client portfolio values and the billing, invoicing of those fees. From our perspective, we have been kind of experimenting with pricing. We don't have a fixed pricing model across our offering. For non-discretionary advisory, our fee has kind of stayed around 50 basis points per year, which is actually a fraction of the cost of a qualified custodian if you had to go that route. For on-chain SMAs, we're still working on defining what the fee will look like. On-chain SMAs will similarly enable advisors to charge their own fee, which is going to happen programmatically. They don't have to charge that in arrears. Our fee is going to be anywhere between, I think, 10 basis points and 50 basis points. We'll see. And then for more complex strategies like the hedge fund grade strategies, it might be a little bit more than that. We still haven't firmed that up, but it'll always be more competitive than the alternatives.
Just a few minutes left here. If I recall correctly, the way that we connected out on X was around some of my tweets about tokenization. And I think you know that it's my belief, and I'm not going to give a definitive time frame, but ultimately, I expect every financial asset to be tokenized in some way, shape, or form. And I bring that up because a common thread throughout Crypto Prime through this podcast since I started it has been the tokenization of asset classes moving forward. And I would just love to get your perspective on that, just how you see this playing out, say, over the next decade or so. Do you think every asset will ultimately be tokenized?
Yeah, I think everything gets tokenized. Every market, everything that has value will get tokenized. The path, I think, will evolve as the investors who are actually on chain kind of gets defined. Today, the tokenization of assets caters to very crypto native investors and the state of the market. I think like treasuries have been the go-to instrument to tokenize because there's over 100 billion. Well, there was over $100 billion in stable coins in the last bear market, kind of parked on the sidelines, held by crypto native investors. And issuers were looking at that and saying, "Hell, those stables are sitting there getting no yield. These investors are going to react well to a tokenized money market fund." And effectively, that was the right move. I think now that we're in a bull market, you may start to see maybe tax advantaged products being tokenized. So if I'm a crypto native investor and I'm now sitting on a bunch of gains, or I want to diversify in a tax efficient manner, well, maybe issuers are going to cater to that need. It's hard to say what those things will look like, especially 10 years from now. I think next year we continue to see more around stables. I think we've only scratched the surface of like what you can do with cash on chain. Yield is one thing, but I mean, there's all sorts of opportunities, especially around margin, that we haven't explored. I think prime brokerage can get a lot more competitive on chain than it is traditionally. And then tax advantaged products, maybe I'd like to see munis being tokenized. Large whales in crypto that want to diversify, that want to create income in a tax efficient income, would actually be interested in these types of products. We'll see. I think that's for the market to tell us. But yeah, ultimately, all asset classes will be tokenized. It's a no-brainer.
And the beauty of that is, if it's on chain, then L1 will likely be able to handle it.
That's right.
Miguel, so great to connect. Really enjoyed learning about your platform today. So best of luck to you and your team moving forward. And thank you for joining me.
Thank you for having me, Nate. This was a great chat.
That was Miguel Kudry, CEO of L1. I hope everyone enjoyed this episode of Crypto Prime. Please be sure to leave a review or give us a like wherever you're listening or watching. Apple, Spotify, YouTube. This podcast is now available pretty much everywhere. So please drop a review, and thank you for listening.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.